Of your refund, we have Brian Balke, a wealth advisor with Legacy Trust. Thanks for being here this morning.
Yeah, thanks for having me.
Yeah.
Hi, Brian. Maybe we just start with this, talking about lowering the tax burden. If you're a family of four, what's the approach?
Yeah, most likely that family is filing the standard deduction, right? So they're not itemizing. So one thing they can look at is, if they're a family of four, they have a couple kids, maybe look at doing a 529 contribution. If it's a married couple, you can deduct up to $10,000 at the state level towards your taxes. And also, this is the time of year you're getting that holiday bonus. Maybe you take some of that and put it towards your retirement plan.
Yeah.
A traditional allocation is going to get you, a lower tax burden to ultimately pay tax on in the spring.
And that includes those education tax cuts too that you kind of talked about there.
Yeah. So, kind of fast forwarding, if you've got maybe an older set of older kids, they're in college, paying those education costs now could allow you to get, the American Opportunity Tax Credit that you can elect on your tax return and get some money back that way too.
What about those couples that are empty nesters and they're like, holy cow, we have all of this. What do we do with this?
Right.
Yeah, and that's a situation where you could look at potentially bunching, right? So like I mentioned before, the standard deduction right now is just over $24,000 a year for a married couple, which is pretty high. That makes it hard to itemize, right? But if you are in that situation and maybe you do, contribute charitably, maybe you've got, some property taxes you can pay, and if you can get yourself over that $24,000 hurdle, you could look at itemizing and kind of, taking advantage of some tax savings that way too.
Okay, and then we move into the next phase of life here, right? So what can a retiree do to kind of lower their burden? Yeah,
so in that situation, at this point, if you're a retiree and maybe your income is, Social Security income, and you've got an IRA account and you're over age 70 and a half, at that point, you may be forced to start taking out that required minimum distribution each year. The government lets you grow that money tax deferred, but ultimately they want some tax revenue back. As part of that, you can contribute money directly from your IRA to a qualified charity, which means you're not paying tax on that portion. So that's something, at this point, we're probably late in the year for that, but thinking ahead to 2020, it's something to consider.
Yeah, let's talk about maybe some of the planning we do for 2020. Where should we look at?
Yeah, I guess, if you're working, going back to that kind of that family of four, look at your withholdings, make sure you're withholding the proper amount from your paycheck. Look at allocating to that retirement account, making sure, one, you're saving for retirement, and also you could be saving some tax money at the same time. And then, again, that empty nester, think about bunching, think about doing, hey, is this the year I want to contribute a little bit more to charity? Maybe utilize a donor advised fund or something like that to get yourself over that standard deduction hurdle.
All right, and if people want some more direction or advice through all of this, how can they reach you and your services?
Yeah, they can go to legacygr.com. We've got a wonderful team of people who'd be happy to help.
Awesome.
Great.
Thank
Brian,
you very
thanks for
much.
being here.
Thank you.
It is